Hey there, welcome back to our channel where we discuss all things finance and economics. In today's video, we're going to be talking about a term that's been making headlines recently, Fed rate hike. The Federal Reserve, or the Fed for short, is the central bank of the United States. One of its main responsibilities is to control the nation's money supply, which it does by setting a target for the federal funds rate. The federal funds rate is the interest rate at which banks lend money to each other overnight. When the Fed raises this rate, it becomes more expensive for banks to borrow money, and they in turn raise interest rates for consumers and businesses. Some text goes here: so why would the Fed want to raise interest rates in the first place? Well, one reason is to combat inflation. When the economy is growing too quickly, it can lead to rising prices, and higher interest rates can help to slow down that growth. Another reason for a Fed rate hike is to prevent asset bubbles. Low interest rates can encourage investors to take on more risk, which can lead to speculative bubbles in the stock or housing markets. By raising rates, the Fed can help to prevent these bubbles from getting too big and causing a financial crisis. But a Fed rate hike isn't always good news. Higher interest rates can make it more expensive for consumers to borrow money for things like homes, cars, and education. It can also lead to a stronger dollar, which can hurt U.S. exports and make it more difficult for American companies to compete in the global market. So there you have it, a brief overview of what a Fed rate hike is and why it matters. While it can have both positive and negative effects on the economy, it's ultimately up to the Fed to determine when and how much to raise rates based on their assessment of economic conditions. Thanks for watching, and we'll see you in the next video.